Recall that the main job of the Fed is to control the money supply through monetary policy. What tools does the Fed have at its disposal, and which is the most important of the tools? The main tool of the Fed is open market operations. Recall that open market operations are when the central bank directs their bond desk agents to go into society to either buy bonds or sell bonds. They can buy bonds from banks or private bond dealers, or sell bonds to banks or private bond dealers. Now, if the Fed buys bonds, it is conducting expansionary monetary policy. In purchasing these bonds, the Fed leaves money, either with the bank or with the private bond dealer. In the end, both the money supply and supply of loanable funds increases. But we will now talk about the details of the differences between the two. If the Fed buys $1,000 worth of bonds directly from a commercial bank, then the $1,000 the commercial bank gets from selling those bonds is all excess reserves. In just this one action, the Fed buying a $1,000 bond from a commercial bank, the money supply has not changed, but excess reserves in the banking system have increased by $1,000. Once this bank does loan out the $1,000 of excess reserves, then we know the money supply will increase by $1,000, and then this will likely come back as a deposit in some bank, and some will be held, and the rest will be loaned out. Then that amount will be deposited in a bank in the banking system, some will be held, and the rest loaned out, and the cycle will continue with this loan deposit, until the money supply ends up being increased by much more than the original $1,000 that the Fed put into the system. Let's assume the reserve requirement is 20%. Remember the equation from one of the previous lessons stating that excess reserves times 1 over the reserve requirement as a decimal equals the maximum potential change in the money supply. Since we said the reserve requirement was 20%, the deposit expansion multiplier is 1 over 0.20, which is equal to 5. We find out through the Fed's action of buying $1,000 worth of bonds from a commercial bank, the banking system would be able to increase the money supply by $1,000 times 5, which is $5,000. But now let's say the monkey didn't buy bonds from the commercial bank. What if it bought $1,000 worth of bonds from the private bond dealer instead? As soon as the monkey puts the $1,000 in the bond dealer's hands, that is money that someone can say is theirs, and money that was not in society before. So just from this one action, the Fed buying $1,000 worth of bonds from a private bond dealer, the money supply instantly increased by $1,000. Next, let's assume that the bond dealer does not want to get their eyes stabbed out and robbed, so they put their money in the bank for safekeeping. That is, she makes a $1,000 deposit in the bank. Again, let's assume the reserve requirement is 20%. This means commercial banks must hold 20% of all deposits as reserves. Since $1,000 was deposited, how much does the bank have to hold? Now let's assume this is the only bank in the whole banking system that has any excess reserves. Using the equation from before, and given that the total excess reserves are now $800, the banking system is in a position to change the money supply by a maximum amount of how much money? Yes, because it has excess reserves of $800 and the deposit expansion multiplier is 5, the banking system is in a position to increase the money supply by $4,000. So in the end, if the Fed buys bonds from a private bond dealer, by how much can this action change society's money supply? It can increase the money supply by $5,000. $1,000 was just by plopping the money into the bond dealer's hand, and $4,000 through the loan deposit cycle of the banking system. Let's go over the difference between if the Fed purchased $100 in bonds from a commercial bank compared to if they purchased it from a private bond dealer. If they purchased $100 in bonds from a commercial bank, the commercial bank does not have to hold on to any of that money as required reserves, since it's not a deposit into the bank. Because of that, excess reserves generated from this is $100. The bank is allowed to loan out all $100. You take that amount of excess reserves times 1 over 0.10, 1 over the reserve requirement, and that will get you $1,000. The total increase in the money supply would be $1,000. If they purchase from a private bond dealer, the excess reserves generated are only $90 because the $100 is deposited into a bank as a deposit. The bank must hold on to 10%, and then the excess reserves from that is only $90. $90 times our money multiplier would equal $900. They gave $100 to the bond dealer when they bought the bonds, so that's $100 the Fed created in society. We need to add that to the multiplier rounds, and we get an increase total in the money supply of 900 plus 100, which is equal to 1,000. Notice that the total increase in the money supply is both 1,000, but the excess reserves generated from buying from a commercial bank is $100, whereas the excess reserves generated from buying from a private bond dealer is only $90. That's the difference. It's very subtle, but that's the difference. So in questions, if they're asking you how much excess reserves is generated from the purchase of bonds from a commercial bank, or how much excess reserves is generated from the purchase from a private bond dealer, there's going to be a little bit of a difference. However, the total increase in the money supply is going to be the same. In both of them, it's going to be $1,000. Notice that if you take the $100 value of bonds purchased times the deposit expansion multiplier, it will give you the total increase in the money supply in both cases.